Okay, so at this stage, we now have a really good grasp of the economic logic which explains how we can raise startup capital by selling tokens, and a good view of many of the practicalities that go into creating an offer, going out and raising funds, and then finally listing the new tokens on an exchange. All of that understanding equips us to ask an important question. Do we want to fundraise with tokens at all? You might think this is a strange question to include in a course that's looking at token fundraising and listings, but it should be a matter that you're able to take a view on, because raising funds with a token sale may not be the best choice for some projects, and at the very least is a decision that comes with nuanced trade-offs that need to be clearly understood by founders and executives before they take the plunge. Let's begin by reiterating that equity and tokens are not the same thing. Now, we covered this already when we explored the value underpinnings of each asset. We're going to look at those details again and a few more that also carry significant consequences. To help us do this, let's compare tokens and equity side by side on a table with respect to a few key attributes that you see coming up on screen now. Let's begin with a way that equity and tokens are alike. Neither of them impose a payment obligation on the issuing system or company. In that sense, neither is debt-like, and the absence of these kind of obligations is attractive and provides flexibility over how that company or economy develops. Let's switch over to the investor perspective and ask, what benefits do they get from buying these assets? Here there are substantial differences that many fail to appreciate. Equity ownership comes with several legally enforceable rights. Now, the specifics may vary from company to company and jurisdiction to jurisdiction, but generally it's expected that you're going to get the right to vote on important decisions and elect directors, the right to participate in meetings, receive dividends, inspect relevant company information and records, the right to sue for wrongful acts, the right to residual claims on companies' assets. Now, tokens so far don't come bundled with a similar package of legal rights. The ambition was to create something to the contrary, an instrument that is trustlessly and intrinsically self-enforcing with the help of cryptographically secured, immutable, transparent code. Ideally, these features would serve as a substitute for legal enforcement. So, tokens only enable their users to take actions defined and enabled by code. The code that's on the host blockchain, any smart contracts that are exclusively designed to interact with this particular token, and any other smart contracts that the token is interoperable with. Now, as I've noted elsewhere, the code that enables these actions may be flawless and unexploitable, or it may not be. Unlike the equity case, there is no legal process to write any deviations in function away from the original intended purpose of these designs. So seeing these privileges side by side, it's clear that equity grants its holders more transparency, oversight, governance, participation, and some significant limitation to downside risks. Now, as regulations become clarified, I have no doubt that we'll come to see a similar list of legal requirements be introduced for tokens. In fact, regulatory standards do already exist for security tokens, which are designed to be a tokenized replica of ordinary securities contracts. So say we're dealing with a security token that tokenizes an equity interest, well, those tokens will be required to fulfill exactly the same standards and legal obligations as traditional equity securities. But right now, most tokens issued aren't security tokens, and that's being done so that projects can escape all of the regulatory overhead and burdens that would be imposed on them if they were to issue securities. So right now, the differences that you see here in these rights and privileges show up in sharp relief. Right, so all that detail is taking up quite a lot of space. So let's just summarize these 2 points as shown. Equity grants legally enforceable rights, while tokens just confer the ability to take actions in ways that are determined by code. Okay, let's now compare how these instruments generate a financial return for investors. Both need to be sold. In the case of equity, that's because it would just take too long for an acceptable return to build by dividends alone. We noted that an advantage of tokens, however, for investors is that they give them the opportunity to exit earlier and more flexibly. And the nature of the markets that they are sold into can create these extraordinary opportunities for upside. What a lot of people fail to appreciate, however, is that the sale of these assets can have dramatically different consequences. It's fair to say that the sale of equity has no immediate impact on a business, and that's because an equity security is a purely financial instrument. It plays no active role in the production of the goods and services that a given business creates. So if Tesla stock dumps because Elon tweets something, that has no immediate or direct impact on the operations of its manufacturing plants or its dealerships. Now, with the exception of security tokens, the sale of utility tokens is very different. These typically are working assets in a business or economic process. They might be being used to create economic incentives to motivate certain user behaviors. They're also assets that are managed by a project treasury to advance the ends of the economy or enterprise. In these situations, disruption to token pricing and value outside of some tolerable range will have consequences on those economic processes and the financial viability of that project. Unfortunately, the early liquidity that investors get access to for their exits is often not very deep, so their sales can create very large impacts on the token price, and that can create highly disturbing effects for economic performance and financial sustainability. Now, perhaps this wouldn't be a problem if investor interests were aligned with the project's economic performance, but in important ways they aren't. In the equity case, because this asset isn't interacting with the business operations, investors and the project can coordinate effectively around shared financial interests. And because of the means available to transact early-stage equity, both the project and investors have to cooperate closely on all financial transactions up to the IPO. Only then do the investors gain greater independence over how they exit their stake. In the token case, the freedom and sovereign control granted by standard wallet and token designs mean that project and investor parties can act independently as soon as the tokens are released to them. And when you add to that the fact that this asset is performing financial and operational roles, there is a lot more opportunity for interests to diverge and even actors to become adversarial towards each other. Investors, say, could exploit a favorable market event to sell, which hampers the ability of the project to finance itself or build value in their token to meet other operational objectives. So I hope this goes some way to explain that for the time being, there are some pretty important trade-offs that need to be understood by project executives in order for them to decide whether fundraising with a token sale really is in their best long-term interest. So let's try and wrap this up in a summary that answers the simple question, when is a token sale preferable? And answer that from the point of view of the project and from the point of view of investors. Well, the first point to consider is if our fundraising token has been designed to play a minimal operational role, some of the issues that we've been discussing go away. Now, the problem with that is that opting for that choice will make your token look more like a standard security, and that will stop your projects and investors from accessing the significant benefits available to them in the current lightly regulated environment for non-security tokens. Some of the associated benefits here are saving time and money on legal and compliance costs and processes, and that translates into faster negotiations as well. These lower costs on the individual investor level and the easy fractionalization of the investment interest allow the project to field the investment to smaller investors, and that increases the sum of capital it can access. On the investor side, the smaller investments are also more economical, and they can deploy their capital to gain exposure to a larger number of projects. Back on the project side, they get the benefit of avoiding some of the managerial oversight that equity interests carry and get to retain full control over their company. Both parties stand to gain from a token sale if the market is buoyant. That enhances the privileges from the early liquidity that tokens grant investors, and it also creates conditions that allow for financial return to be generated without compromising the core business processes of the project. But in cooler markets, with all the scandals coming to light, equity has made a bit of a comeback, and the larger costs and stakes at hand are driving greater diligence, and maybe it also does a better job of pairing up builders and investors who have committed long-term visions and grit to see through that long-term vision. But if you're going to link your capital raising to tokens and equity, you need to be mindful that this will have implications for your tokenomics. A sound and sustainable plan has to understand that there's only so much value being generated and captured by the project. Distribution of that value to investors and token holders has to be thought through carefully. So what do I think is coming up ahead in this space? A lot of this is my personal opinion, but perhaps you'll find my arguments convincing. I think we're getting to a point as an industry where understanding is settling that token sales don't give you a free ride. At the same time, longer-term oriented investors are beginning to see that some of these difficulties count against their ability to realize better returns on their portfolios. Well, this is helping to deflate or at least temper expectations of what token sale fundraising can deliver. At the same time, the choice to fundraise with equity or security tokens is still heavily distorted by the massive disparity in regulatory treatment. These disparities are going to close by the mid-2020s and should enable more level-headed assessments about what the best fundraising methods are. Concomitantly, we'll be able to have a straightforward adult conversation about whether the project really wants to raise capital with a utility token that is primarily intended to perform work in an economy, given the risks and complications we see that this entails. And as we see token fundraising becoming more normalized and expanding to traditional equity investors, I expect we're going to see investment contracts that blend token and equity features together. These could follow models similar to convertible bonds, which allow holders to convert these assets into equity if the price rises at a certain level. Or perhaps we could have tokens issued to wallets that come with pre-embedded and pre-agreed controls on liquidation, say that the wallet caps the number of tokens that are sellable in a given period or limit sell actions to specific market conditions that are agreed in advance. Or alternatively, we could have more contingency in the vesting contracts that govern the unlock of our token, so that vesting is conditioned on verifiable project milestones that have an economic basis and that are not just being paid out to investors regardless of what's happening with the project. For the time being, none of these kinds of contracts is gaining any sort of traction, and the standard token sale format that we're covering in this course remains dominant, and I expect that will continue to be the case until regulations around the issuance of utility tokens and their listing changes. But nevertheless, it's worth staying open-minded and creative so that you can understand the inherent limitations of the current format and be ready for when newer contracts do emerge. And hopefully those new contracts will work to everybody's benefit: investors, founders, the project, and the beneficiaries of the new blockchain assets and services that they create as well.